Good morning. This is Ken Long from Tortoise Capital with a review of the weekly Tortoise trading reports for February 17th, 2013. The market is bullish quiet. It's at 69 out of 100 on the weekly RSI 14. It's at 84 out of 100 on the 10-day NDX, so it's slightly overbought. The percent stretch above the 200-day moving average and then the slope of the 50-day moving average are both coded green bullish. That's very strong. That gives us about 7% cushion to sideways market conditions. ADX remains strong, trending up at 35.4. ATR percentage is quiet at 0.74%. The risk index, which is the 30-period VIX moving average divided by the 10, is at 1.02, so that remains risk on. The Z-score of that reading compared to the last 20 years is 0.20, so that's also risk on. And at a normal level, and you can see that reflected time series of the last 30 days. We had periods of volatility and then declining volatility. This was a very good volatility trade here, betting on lack of volatility. Stayed positive for a long time and now has come back to the zero line and just starting to get quieter again. That's how to interpret this little tick up here. Blended monthly rebalancing portfolios, no changes scheduled until 1 March. Theoretical exposure in ETF2 is at 100%. The model portfolio is at 100%. No changes in that portfolio except to adjust some trailing stops up. And here's a link to a trade of the week explanation for you at the YouTube channel. Taking another look at the blended monthly rebalancing portfolios. You can see the rotation is now to risk on in the U.S. with IWM and MDY near the top. And in the 26 ETF portfolio, that includes financials at the top as well. The financial sector has been doing well with all the money we've been printing and giving to banks. And they've been investing it in the stock market, driving it up. We'll see how long that lasts. In the 13 ETF, only treasuries are on a cash position. Inside the 26 ETF, it's emerging market bonds, gold, treasuries, and agriculture. So real assets. Next up is the market health check. Vertical blue lines are 10, 20, and 30 days of look back. You can see now that we've trimmed out the big gap up session, and here at the regression channel has gotten very narrow and starting to decay a little bit. You can see the slope of the 30 in the background here is declining, but still positive, still quiet, still within the channel, still marching upwards. The price is still in the floodplain outside of the Bollinger Band River, and so we still have price better than the 10 period, better than the 30 period, better than the 50 period, better than the 200 period moving average, so that's all good. Long, strong trend here. You can see when price is out of the river, that's the indication. ADX is sort of leveled off here at about 35. Bulls still in charge, but declining a little bit in their weakness, with the weakness in here. A couple pullbacks, but nothing significant to report. Market is pulling away from the 200 period moving average. Even the river is flowing away from it. You can see how long we've been overbought. It can stay that way for a long time. Really, the only sign of weakness here has been the percent price oscillator, which signaled weakening here, and the jaws are open to the downside, but you can see we're still marching up quietly. So that oscillator is just simply saying, hey, it's at overbought conditions, stay in that way. The next easy move is down, and we target these horizontal red lines at about 149, 145, 146, 145 as previous levels where price has held support. That third red line is what preserves this gap up move. That's the strongest support, I think. but the Bollinger Band mean looks pretty strong here too. So, unadulterated bullish market up, bull quiet. That's the direction to play it until proven otherwise. Regional reports from ETF2 database, all are positive on the moving average filter, so that leaves us at 100% invested. Full quiet market. Globals are just still a little bit better than the U.S. large caps, but not for much longer, I think. Getting close to parity. The two strongest sectors, Europe and Asia less Japan, the two weakest. The NASDAQ because of the crunch in Apple, and ILF Latin America. World market model tells the same story. Mid-cap value in the U.S. has gone to green. Everything else in the U.S. is above average except for the Dow and the NASDAQ directly. Japan starting to lag a little bit now. Asia less Japan is strong. China, Australia, Hong Kong, India are above average in Asia, but what was once strong is now weak, with Malaysia and Singapore both below average, in Malaysia very much so. Latin America emerging markets are lagging. Only Mexico in the Western Hemisphere showing strength. Strength everywhere in Europe, less the UK. You can see parity now in the business sectors, U.S. versus the globals, and really the strength starting to swing over towards the U.S. side now. So slow rotation to the U.S. Top ETFs in the ETF database. This now includes about 1,400 ETFs. Have added a bunch of new ones. To make it on this list, they have to have more than 100,000 shares of average volume. So that now brings that population to about 350, up from the 200 that we've usually been tracking. You can see at the top now, it's sorted by relative strength. Vietnam, oil and gas, clean energy, Philippines, total dividend, Japan, U.S. home construction, timber, China small caps, and so on. Those that are green in the strength column but white in the average column are ones that are coming on strong. So clean energy, energy alpha, transportation, U.S. oil index, those are all sectors that are coming strong. The ones that are green in the average but white in the strength are ones that are starting to weaken a little bit. China real estate and water. That's how you can start gaining some insights into the sector rotation. Looking at the Dow 30 with the same lens, sorted by strength, Bank of America, J.P. Morgan, Travelers 3. The top three are financials. No surprise there. United Tech and Hewlett Packard come on strong. Hewlett Packard has been a very good success story on its recovery from washout conditions. It's moved from the terminally worst for about 4 months and has now moved up into the 5th position. Notice the green strength followed by yellow inconsistency and average. So it's still early in its relative strength move. That's the reason, I think, to be interested in the bottom feeders. It's moved from 13 to almost 17 in a matter of a couple months, and that's a 25% move off the bottom in a large cap company that everybody has to own. So the two bottoms now are Merck and Intel. Walmart, Coke, Microsoft is the value plays inside the Dow. Top 30 ETFs by daily dollar liquidity. You can see the risk-on trade is now starting to favor IWM at the expense of the NASDAQ, with almost 33% more volume on an average day. Those that are highlighted green are a combination of both very liquid and very volatile intraday. So that's the VIX and gold miners. All right, we'll shift gears now to the daily report. And I won't reread the top row, but you can see we've been overbought and stay that way with a 10-period NDX. No signals in overreaction or channeling. You can see the last 6 months of volatility as measured by ATR divided by price. So this is the last 100 days of ATR percentage. And we were very quiet, came up just nicked into normal for a day, and then are still on the boundary between normal and quiet. So ADX is just dominant strength up. Pivot points for reference, the VIX Z-score I've already discussed. The VIX reading today is 12.46. So it's still a fraction above the critical number of 12.19, which would be one standard deviation below the 20-year average, which is 20.6. So still very quiet on the risk side as measured by the VIX. 10-day max pain candidates. These are the ones that have the greatest percentage pullback from their 10-day high. Coke, Caterpillar, Walmart, Bank of America, and Boeing. Inside the ETFs, that's VIX, natural gas, gold miners, silver, and DBA, the weekend of the ETF database. Some channeling and overreaction in Japan, channeling in Caterpillar, 5-day down patterns in agriculture, Japan, treasuries, and tech. Triple screen available in basic materials and McDonald's. 551Ws available in blended commodities, oil, McDonald's, and Coke. Auto framer, these are all symbols that have tested out better than 2-to-1 simply based on trade location, using a mechanical entry, yesterday's low as the risk, and then a return to the 10-day high as the potential profits. So those are all worth looking at. Dow tactical summary, again, just a couple dojis. Max pain range compression in Caterpillar. So Caterpillar should be of interest to us. It's at 11 on an RSI2, so it closed weekly on Friday. Has a 2.1 reward to risk. It's the number one max pain range compression and a channeling pattern. Coca-Cola should be interesting. It's a 551W, which is good. 2.5 on the reward to risk ratio. Boeing at 2.7 just based on trade location. Walmart should be of interest. It's a max pain. It was a big percent loser on Friday and closed with an RSI 2 value of just 1. So that's pretty good as a tactical play. I'll be covering those patterns with trade markups for subscribers in the weekend webinar. ETF 30 dojis, half a dozen of them, channeling an overreaction in Japan, which had an 8 on an RSI 2 value. DBA should be of great interest. It's number 4 on max pain range compression. It's a 5-day down. It closed at a 0 on RSI 2, probably a limit down move. Gold and silver are both attractive now on a tactical basis. They have RSI 2 values of 1 and 2. They were big percent losers on Friday. They're number 3 and 5 respectively on max pain range compression, and both are better than 3 on the reward to risk ratio, so that's a decent opportunity. Latin America may be of interest conversely because it was a percent winner on Friday, but still tests out at 2.9 to 1 reward to risk ratio, so you could buy second day momentum there if you're inclined to reward strength. 551Ws and blended commodities and oil, and here's the triple screen as you can see in XLB. Multiples that test up better than 3 to 1 on the frog, so a lot of opportunities in there. The market mosaic regression line, it doesn't get any more bullish and quiet than that little march up. Although price just slightly below the regression line, you can see we've crossed below the 10-period moving average of the regression line slope at an extreme distance. That just says there's vulnerability, and that this end of the curve is not as strong as it was earlier in the curve. That's what that means. You can see how that plays out historically for the last 6 months. Had a nice strong move. The market is kind of marking time in terms of regression. It's really hard for it to get much steeper up than this unless we get some extraordinary buying pressure that gives us range expansion. But at this bullish quiet, it's just hard to get any better in terms of a regression line than this. There's been no surprises, no shocks, no runaway buying. The market's if you will look at it as a movement compared to the 200-day moving average, we're as strong as we've been at any point in the last 6 months. up almost 10% above the moving average. It's over 1 standard deviation better compared to that look-back period. So again, we're closer to the tail end than the front end of this powerful move. So stay long, stay strong, reward winners, but respect your stops, because when the market is this quiet for this long, all of the upside surprises may have been baked in, and the big shock is to the downside. So respect your stops. Z-scores of swing gains. This quiet bull, it's not a runaway bull, and so all of these are these Z-scores are under 1.0 for these typical holding periods. Nothing really. There's no runaway move in there. That's evidence of quiet marching up. Really, the one to be interested in is Cliffs Natural Resources. Just got crushed this week with an 18% sell-off, and so that provides some opportunities for recovery from max pain, certainly, and some easy upside tactical trading frames will be built over the next probably 2 to 3 months. So Cliff is back on the radar screen. Only XLP tests out at extremely strong on the upside. That's that perhaps rotation to the U.S. large caps and value plays, mature companies, consumer staples, those kinds of companies. So that's really, along with finance, that's sticking out as a really strong move. But even the move in XLP is much greater than the move than XLF on a relative basis, as you can see by the Z-score shading green. Z-scores of the regression line slopes. The 90 has come up to the edge of the 1 standard deviation Bollinger Band here, and that's a reflection of this these last 180 days. It's been a really powerful move, and so the slope of that regression line is about as strong as it can get. Hard for it to run away much further. The 30, as you can see, we've already noticed, is rolling over. The 10 has not been running away and is pulled back towards the median, and you can see almost a little bit of the steam coming out of this move as it comes back to test the edge of the river. And you notice the Bollinger Band width is narrowing here. So really this is sort of it's checking in to see what the next move is. Support is still, at the bottom of the river is still above the previous swing highs. So what was once resistance could now be support. But market getting ready to go into the next phase. And it remains to be seen whether that's up or down. Same chart functions for Treasuries, gold, and IWM, which has been stronger than the S&P, hasn't even crossed over its own 10 period. Treasuries just decaying. Gold voted down this week, breaking 160, but again, strong support in this 155 area. Gold becoming more attractive just on a reward to risk basis. Just some reference charts. I'll leave them for you to stop the video and review. Nothing I really want to comment on in here. These are the standard stats we use to help us frame trades and refine our understanding of particular targets. Just note how commodities have been crushed on a relative basis to the S&P, whether it's blended oil or gold, at coming down to extremely noticeable sell-offs here. You can see in IWM and MDY the return to risk on as the Dow has decayed. Risk on trades have started to work a little bit on those relative regression lines. Various quality reports, pivot point reports, and the Elder Safe Zone Index. Extremely quiet across the board on ATR percentages. Only gold shows extreme volatility on it relative to itself. It reminds me of the old Western movies. It's quiet. Yes, too quiet. So Adjust your stops. Continue to take advantage of the bull. Follow the strength, but be sensitive to nonlinear changes in market conditions, which they can happen quickly. And fortune favors the agile. So this is Ken Long from Tortoise Capital. Good trading. Keep your risk measured.